Hey everybody, I thought I'd have a little bit of fun with this one. Battle Royale, fixed indexed annuities versus bonds and bond mutual funds, okay? I've talked a lot about this, but I want to dig in and show you the last couple of decades of what's happened out there and what's going on out there and why is there such a transition from the bond world to the annuity world. So here it is. Let's talk about some of the differences between bonds and fixed indexed annuities, starting with access to your money. Okay, that's always an issue. Well, look, bonds, you have 100% access to your money, but you have to hit sell, and that's based on the market prices. So you may make or lose money depending on where you got in and where you're getting out. 2022, you could have lost anywhere from 10 to 20%. We saw a lot of bond mutual funds hitting 20% losses in 2022. So understand, your exposure to loss is real because you have to hit click sell and the market has to tell you what the price is. Whereas a fixed indexed annuity, you have the option to taking up to 10% of the full account value with no penalties, with no questions asked, and without any market risk. But it's only 10%. If you need all your money, you're going to have to pay a penalty. Those penalties nowadays range anywhere from, say, 9–10% down to zero. The further you are into that contract, the less the penalty is. So you're now defining that risk, right? So instead of a 2022 hitting you for 10, 15, 20%, you know what your parameters are with a fixed indexed annuity. Nobody likes paying penalties, but it's no different than you selling at a 10% loss, right? And at least we have that window of 10% access without any risk, without any market-based selling going on, without any penalties. So we have to understand it's a give and a take on that side of it. Next part is fees. Well, bonds, you will have fees. You'll have mutual fund fees, you'll have advisory fees, and you'll have commissions, certainly, if you're buying and selling individual bonds. They don't disclose those commissions, but trust me, they're there, okay? When it comes to fixed indexed annuities, okay, there's no fees. There's truly no real fees coming out of there. The commission that is paid to the advisor up front is a commission paid by the insurance company, and it does not come out of your money. Just like when you go to a bank and get a CD, the bank is paying the teller that put that money in the CD and had you sign the contract on that one, which is strangely very similar to an annuity contract, okay? Taxation. What's the difference in taxation? Well, bonds, you'll get taxed on the interest you're paid, okay? So if you own a bond fund, sometimes they'll refer to them as dividends, but it's interest you're being paid. It's a capital gain or loss when you go to sell, okay? So then you'll have to pay taxes on that as well. Fixed indexed annuities, it's all interest. All annuities only pay interest. So the profits that are coming out are considered interest, but they're tax deferred. So you are only going to pay taxes on what you pull out when you pull it out. So you get to choose when to pay taxes on this stuff. Then there's the risk parameters, okay? Bonds, there's lots of kinds of risk in bonds. Interest rates, when interest rates rise, 2022, interest rates went straight up, you will lose money in any kind of bond that you own, okay? Then what about if they call the bond due? So if you go buy an individual bond, and we see people overpaying for bonds all the time, the maturity value is, say, $25,000 and you're paying $26,000, $27,000. They call it due and they give you back your $25,000. You just lost that extra money you paid for that, okay? You're counting on getting that interest through maturity and they call it due beforehand and hand you the par value back. That's a risk, okay? Then there's the credit downgrade risk. If you went from AA to single A to triple B to junk bonds, that's a problem. They downgrade it, you have less value. When you go to sell, you won't have the value in there that you had in the beginning, okay? And then you've got the fee exposure as well, which is a risk because if you just went flat sideways and they were pulling out a fee, you're losing money, okay? Fixed indexed annuities, by regulation, no risk at all. You are not allowed to lose your principal, period. In the vast majority of them out there, you can't lose principal or any earnings that you ever earn in there. So understand, there is truly no risk, and that's one of the huge reasons. Okay, so you would think by looking at this, you've got the risk parameters of bonds, you should get paid more. With more risk means better results, right? I mean, that's the way we all think about it. Throw all our money in the stock market, we expect to make more, right? I mean, we're supposed to. Doesn't always work out that way. Well, here's the results. First thing I want to show you is the change of interest rates. Okay, in the early 2000s, we just kept lowering interest rates, right? 9/11 happened, and so we had a few years of lowering interest rates, and then we kind of floundered sideways, trying to raise interest rates a little bit by that 2008, but then 2008 happened and we plummeted interest rates. And then we tried to raise them again into 2013, and that didn't work. We plummeted interest rates. And then we tried to raise, 2018 happened, plummeted interest rates. The last of 2018, boy, that was a difficult end of the year. Market went straight down. So we plummeted interest rates in 2019, and we were still lowering them in 2020. When the pandemic happened, we hit all-time new lows. I think we got down to 0.5% on the 10-year. It was crazy. Lowest interest rates you could ever imagine in the United States. Then, end of 2021, 2022, interest rates skyrocketing. Well, let's look at what happens with bonds. This is the benchmark that most people push their bonds, at least compare their bonds to. This is the Barclay Bond Index, okay? So we look at this index, and when interest rates are going down, you see that you're earning and doing fine, because this is a function of earning interest. So in early 2000s, interest in these bonds, there was a lot more interest. People, the corporate bonds, AAA, AA, single A, were all paying 5-6%. Okay, no problem. 5-6% was easy to find back then. But they pay you that interest. Interest rates go down, well, that interest is more valuable, so the value of those bonds go up. So the line shows a good, steady, stable growth when interest rates were coming down a little bit. And when they went up, it was just a tiny bit here and there. And then we get the big plummeting interest rates, we get the big rising interest rates, and you notice you get little peaks and then little valleys and little peaks and little valleys. And then 2021, 2022 hits, and that's when you're seeing the real losses in those bond portfolios, okay? So that's an index. You can't really own the Barclay Bond Index, but you can own BNB, which is Vanguard's Total Bond Market Fund, which is one of the largest bond funds in the world, and the one I most commonly see in people's portfolio. And ironically, it is almost the same as the Barclay Bond Index. And that's the results that we see out of there, okay? So we've got the change in interest rates on this chart. We've got the Barclay Bond Index, which is the benchmark. And then we've got the BNB, the biggest bond fund in the world. Fixed indexed annuities are really no comparison. None whatsoever. When interest rates were going down and bonds were doing just fine because they were already paying more interest than we've seen, because they were at 5, 6, 7% interest, and interest rates kept going down on top of that, well, fixed indexed annuities did fine keeping up and keeping level with bond portfolios that were still doing pretty good, right? But when interest rates started getting fluctuating up and down in the middle of low interest rates, we try to push them up, they fall back down, try to push them up, they fall back down. Bonds just started floundering because the longer we're in lower interest rates, all those bond funds are filled with lower and lower interest rates because all their good stuff was maturing and they had to replace it. So the future of bonds, especially bond funds, until we've had some time up at 10% interest rates, why would we be in them? We're going to continue doing this, floundering sideways. If interest rates keep pushing higher and higher and higher, and we start seeing 10 plus, okay, maybe it's time to start getting back to bonds. But they have no future. They're just going to keep floundering like this. fixed indexed annuities are not tied to those interest rates. They're tied to the stock market. And so the second half of this orange line here skyrocketed because the stock market skyrocketed, which is what led up to that inflation numbers that really hurt everything else. And here we are locking in all those gains. We don't have the risk when the market falls, and we don't have the risk when interest rates rise. So as a safe investment, fixed indexed annuities blew away bonds for the last decade. They kept up with bonds during the good part of the early 2000s. Bonds did just fine. But then the second half, the second decade, 2010 to 2020, they blew them away. When the market starts rocketing and going up, these things do fantastic. When the market's going crazy sideways, these things do just fine, right? So that's the important part. So when we look at this, let's really compare this, even though there really is no comparison. Just because you've been doing something the same way for decades and it worked doesn't mean it's going to continue working into the future. The results of bonds and bond funds have been basically nothing for the last 2 decades. You average it out to about 1% over the last 10 years, 2% over the last 15 years, and barely 3% over the last 20 years. That's an average annual return for bonds. That's ridiculous. And it's all because of the first half. The second half has been terrible, terrible. Okay? So maybe if we see bonds go back to the 10% interest rate range, maybe it's then time to start considering them. But anything beyond that, it's considered a return-free risk because all we're doing is floundering sideways. We push until we break, push until we break. And that's going to result in no performance that we want to be in when it comes to bonds. So floundering at low interest rates is not going to work for anybody. You're not going to get good results out of bonds and bond funds. Whereas fixed indexed annuities, if you can live within the 10% penalty-free access, there's nothing better than these things in terms of a safe investment that's going to help you keep up with inflation. You can also think of the penalty as defining your worst case scenario. Everybody just seems to hate this word penalty. Well, I don't want to pay a penalty, just like people don't want to pay fees. Well, I get it. I totally get it. But I'd rather have that than the market-based risk in the bond world. I don't have the returns for any risk in the bond world. So why would I be okay with that? I'd rather have 10% access in a disaster scenario. If I have to pay a 4, 5, 6% penalty, that's better than being at market-based risk. Because again, let's go back to 2022. You're looking at having to sell at anywhere from 10 to 20% loss. I'd rather pay a 4, 5, 6% penalty in a fixed indexed annuity, right? 10% access should take care of most of our situation if we design the portfolio properly. So it's not about putting all your money in, but let's say you did. If you think pulling 10% from your portfolio every year, your money is not going to last. It's never going to last at a 10% withdrawal rate. So the idea of us needing more than 10%, especially from an IRA, boy, somebody did something wrong if you needed more than 10%. Okay, so hopefully that helps you understand the pros and cons of this and helps you see that there really is no comparison. Bonds and bond funds, don't see value in those for quite a ways into the future. It's going to be a struggle getting to 10+% in bond rates. I promise you that will be a very scary future if we do. And we're going to see a lot of turbulence in the stock market. You're going to wish you were in fixed indexed annuities. Because remember, when the market crashes, you don't lose anything. When the market goes up, that's when you get paid. Market goes up sharply, you're going to get paid more. And that's why there's a good reason for these fixed indexed annuities. And when you compare them side by side to all other safe investments out there, they are far superior. All right, if we can help in any way, you agree or disagree, I'm fine with that. This is always a discussion. I'm talking about them in general. This is not direct financial advice. This is simply me comparing bonds and bond funds to fixed indexed annuities. Comment below if you'd like. I'll be keeping an eye on them. I'm always happy to have discussions about these things. Give us a call, shoot us an email. Always happy to help. See you next week.